$317 trillion. That is the number sitting quietly beneath the global economy right now. $317 trillion owed by governments, corporations, and households combined. More than 3 times the size of the entire world economy. And yet almost nobody asks the only question that actually matters. If every country owes money, who exactly is being paid? Because debt, by definition, requires a lender. Someone on the other side of the ledger, someone who is owed. But when you zoom out and look at the entire system at once, something strange appears. The world doesn't owe money to one country. It doesn't owe money to a group of countries. It doesn't even owe money to a single institution. The world owes money to itself. And that should make you deeply uncomfortable, because systems where everyone owes and no one can be paid back do not exist by accident. They are designed that way. To understand how we reached a point where global debt is mathematically impossible to repay, you have to forget what you were taught about debt being a temporary problem. Forget the idea that debt is something governments solve. Forget the belief that if leaders were just more responsible, this would go away. This system was never built to be solved. It was built to persist. Before modern finance, debt had an ending. Kings borrowed money to fight wars or fund projects. When the war ended, the debt was either repaid or defaulted on. Creditors took losses. The system reset. That made debt dangerous for lenders and embarrassing for rulers. So the goal became simple: remove the ending. The first time this happened was not recent. It happened over 300 years ago. In 1694, England was broke. War with France had drained the treasury. Taxes weren't enough. Lenders were hesitant because England had defaulted before. Then, a merchant named William Patterson proposed something radical. Instead of borrowing money and paying it back, the government would borrow money and never repay the principal. Only interest? Forever. The lenders would receive guaranteed annual payments backed by taxation. As long as the country existed, the money would flow. To manage this, a new institution was created, the Bank of England. For the first time in history, national debt became permanent. This changed everything. Debt was no longer a bridge between 2 points in time. It became a fixture of the system, something that stayed, rolled over, expanded, and crucially, something that could be traded. Once debt became permanent, it became attractive, not to citizens, to financiers, because a permanent debt stream is not a liability. It's an asset. By the early 1800s, this model had spread across Europe, but it still had one weakness. Governments could theoretically refuse to pay. They could default and wipe the slate clean. That weakness had to be removed. Nathan Rothschild solved it. Instead of holding government debt privately, he turned it into a global market. Bonds could be bought, sold, pledged, and used as collateral across borders. Debt was no longer a relationship between borrower and lender. It became a web. Once debt is embedded inside pension funds, banks, insurance companies, and foreign institutions, default is no longer a political decision. It becomes a systemic threat. Refusing to pay no longer hurts one creditor. It collapses everything. This is how governments lost the ability to walk away. By the late 19th century, sovereign debt had become permanent and inescapable. But it still had one constraint. There had to be buyers. Governments could only borrow as much as investors were willing to lend. That limit disappeared in 1913. When the Federal Reserve was created, the final guardrail was removed. Now, governments didn't need private savings to fund debt. A central bank could create money and buy government bonds directly. Debt no longer required restraint. It required confidence. As long as people believed the system worked, borrowing could expand indefinitely. And it did. War after war, crisis after crisis, recession after recession. Debt grew because it had to, because the money supply itself was now built on borrowing. This is the part most people never realize. In the modern system, money is created when debt is created. Government issues bonds, banks buy them, central banks support them. New money enters the system. If the debt were paid off, the money would disappear, which means the system cannot function without debt, not metaphorically. Mathematically, this is why asking, why don't governments just pay it back, misses the point. Paying it back would collapse the system that depends on it. Now scale this globally. The United States owes nearly $40 trillion. Japan owes more than its entire GDP. Europe, China, emerging markets, all buried under obligations. But who holds this debt? Mostly institutions. Pension funds, insurance companies, banks, central banks. Your retirement fund owns government bonds. Your insurance premiums are invested in sovereign debt. Your savings are tied to it, which means you are both the borrower and the lender. You owe the debt, and you depend on the interest payments. This circularity is not a flaw. It is the design. Interest flows upward. Taxes fund payments. Institutions collect. Debt rolls over. And because the system is global, No one can exit without pulling everyone else down with them. This is why debt keeps rising without triggering collapse. Collapse only happens when confidence breaks. As long as people believe governments will continue servicing interest, the system holds. Not because it's healthy, because it's interconnected. The terrifying truth is that there is no final lender standing outside the system. No ultimate creditor waiting to be paid. The debt exists because the system requires it to exist. And once you see that, the question changes. The question is no longer who will pay it back. The real question is what happens when the belief that it can continue breaks. That's where the danger lives. To understand what happens when belief breaks, you have to understand what belief actually holds together. It isn't money. It isn't productivity. It isn't even growth. It's trust. Modern debt works only because everyone agrees to treat government obligations as risk-free. Treasury bonds are considered the safest asset on earth. They sit at the center of every balance sheet. Banks hold them as reserves. Pension funds rely on them for stability. Central banks use them as collateral. This is why the system feels stable, even as the numbers become absurd. 317 trillion doesn't scare markets because markets are not measuring solvency. They're measuring confidence. As long as interest payments are made, nothing breaks. And that is why the system doesn't collapse when debt grows. It collapses when servicing that debt becomes questionable. History shows this repeatedly. Every major financial collapse begins not with default, but with doubt. Doubt that the borrower can continue rolling the debt. Doubt that interest payments will keep flowing. Doubt that the promises underpinning the system still hold. That doubt doesn't appear all at once. It creeps in. It starts when debt grows faster than income, when interest payments begin consuming more resources than essential functions, when governments borrow not to build, but to maintain. That's the moment the system stops compounding and starts cannibalizing itself. At that stage, debt no longer funds future growth. It funds past obligations. This is where we are now. Globally, interest payments are exploding, not because debt is new, but because rates are no longer near zero. For over a decade, the system survived on artificially suppressed interest rates. Cheap money masked structural weakness. Borrowing felt painless. Governments expanded spending without consequence. That era is over. As rates rise, debt reveals its true cost. Interest doesn't negotiate. It doesn't care about politics or ideology. It demands payment. And payment always comes from the same place. Productive output. When output slows, interest becomes oppressive. When output stagnates, interest becomes fatal. This is why highly indebted systems fear stagnation more than recession. A recession can be stimulus managed. Stagnation cannot. Stagnation means the debt grows faster than the economy permanently. That's when belief begins to fracture. Because markets are forward-looking. They don't wait for collapse. They price in risk early. The moment lenders suspect that rolling debt will require currency debasement, capital moves. Quietly at first, then all at once. This is how reserve currency systems die. Not from rejection, from diversification. No country wakes up one morning and declares the reserve currency obsolete. They simply start holding less of it. They settle trade in alternatives. They accumulate real assets instead of paper claims. They hedge. Each action looks insignificant on its own. Together, they signal the beginning of the end. When fewer actors need to hold a currency, demand falls. When demand falls, excess supply returns home. This is the part most people misunderstand. Reserve currency status doesn't mean others owe you money. It means others hold your money. When that stops, the currency doesn't disappear. It comes back. And when it comes back, it collides with the domestic economy that created it. Prices rise. Purchasing power collapses. Trust evaporates. This is not theory. This is exactly how previous systems ended. Spain's silver flooded Europe, then flooded back as worthless coinage. Britain's pounds circled the globe, then returned as inflation and devaluation. The Soviet ruble never gained global trust, so collapse came faster. The pattern is consistent. Debt expands until belief falters. Belief falters when servicing costs outgrow capacity. Capacity shrinks when productive foundations erode. Which brings us to the most uncomfortable truth in this entire discussion. Debt does not destroy systems by itself. Debt exposes what the system has already become. A productive economy can sustain debt. An extractive one cannot. When economies produce real value, debt acts as leverage. When they don't, debt becomes a parasite. This is why late-stage debt systems always coincide with financialization. Money stops being made by building, innovating, and producing. It starts being made by managing, packaging, and trading claims. Paper wealth expands. Real capacity shrinks. From the inside, this looks like prosperity. Markets rise, Assets inflate. Consumption continues. From the outside, it looks like hollowing, and eventually, the hollow collapses. This is why people living through these periods feel a disconnect between numbers and reality. GDP can rise while life becomes harder. Markets can soar while trust evaporates, because the system is no longer serving society. Society is serving the system. At this point, asking who is the lender becomes almost irrelevant. The lender is the structure itself. A self-referential loop where debt creates money, money services debt, and belief holds it together. No individual controls it. No single institution owns it. But many benefit from maintaining it. And that's why it persists. Until it doesn't. When belief finally breaks, it never breaks politely. It snaps. Credit markets freeze. Currencies move violently. Governments respond with emergency measures that reveal how fragile things actually were. And the most shocking part is not that collapse happens. It's that almost everyone insists it was unpredictable. It never is. The signals are always there. Rising debt servicing costs, shrinking productive capacity, financial assets decoupling from reality, public trust eroding, political systems fragmenting. These are not separate problems. They are symptoms of the same structure reaching its limit. $317 trillion is not the cause. It is the measurement, a measurement of how much future has already been spent. And when the future arrives and finds itself already consumed, belief has nothing left to stand on. That is when the question of who is the lender finally gets answered. No one, because in the end, the system has been lending to itself. And systems that do that eventually run out of time. When systems run out of time, they don't announce it. They reveal it. The reveal doesn't come as a single event. It comes as a shift in behavior. People stop trusting long-term promises. Institutions prioritize survival over stability. Governments choose expediency over credibility. This is how debt systems end. Not with a bang, but with a change in incentives. At the beginning of the debt era, borrowing funded expansion. Infrastructure, industry. Growth, debt made sense because the future was larger than the present. At the end of the era, borrowing funds, maintenance, social programs that cannot be cut. Interest payments that cannot be skipped. Systems that cannot be reformed without breaking. Debt no longer buys tomorrow. It delays today. And delay is expensive. This is where the illusion becomes dangerous. Because when debt stops building capacity, the only way to sustain it is through extraction. Higher taxes, inflation, asset inflation that benefits those who already own assets. The system begins feeding on its own base. Workers pay more for less. Savers are punished. Speculation is rewarded. Production is neglected. At this stage, inequality isn't a moral failure. It's a structural outcome. Debt systems concentrate wealth because interest always flows upward. Those closest to money creation benefit first. Those furthest from it pay last. This is why late-stage debt societies feel unjust even when laws remain unchanged. The rules didn't suddenly become cruel. They finally started working as designed. The most telling sign that belief is eroding is not market panic. It's behavioral change. People stop asking how to build wealth. They ask how to protect what little they have. They stop trusting institutions. They stop believing official narratives. They retreat into short-term thinking. This is when capital becomes defensive. Money moves from productive risk to preservation. From investment to hoarding. From trust to hedging. Gold gets accumulated. Alternatives are explored. Long-term bonds lose appeal. Not because collapse is certain, but because continuation is no longer guaranteed. This is the moment where the system enters its most fragile phase. Because debt-based systems require faith in continuity. The assumption that tomorrow will look like today, that contracts will be honored, that money will retain meaning. When that assumption weakens, velocity slows. Economic activity contracts, and governments respond the only way they can, by borrowing more. This is the trap. Every response designed to stabilize the system deepens the very dynamics undermining it. More debt to manage old debt, more money creation to fund obligations, more promises to maintain calm. Each action buys time. Each action reduces credibility. This is why collapse accelerates once it begins. Not because leaders become incompetent, but because options disappear. There is a moment in every debt cycle where reform is still possible. It requires pain, honesty, and political sacrifice. That moment always passes. Because the cost of reform is immediate. The cost of delay is deferred. And deferred costs are politically invisible, until they aren't. When belief finally breaks, the system doesn't ask permission. It enforces reality. Currencies reprice. Debt markets seize. Institutions that seemed permanent reveal themselves as conditional, and the most shocking realization emerges. Nothing was holding the system together except agreement. Agreement that debts would be honored, agreement that interest would be paid, agreement that money meant something. When that agreement dissolves, the system doesn't slowly unwind. It snaps back to fundamentals. Who produces real value? Who controls resources? Who can enforce claims? Everything else is noise. This is why debt collapses are always accompanied by social upheaval. The financial breakdown exposes the social contract. Who owes whom? Who benefited? Who paid? And that reckoning is never polite. The reason this keeps happening is not because humans are stupid. It's because the incentives never change. Debt allows present comfort at the expense of future strain. Every generation inherits the consequences of decisions it didn't make. And because debt grows quietly, the danger feels abstract. Until it isn't. $317 trillion is not a number meant to be understood emotionally. It's meant to function, to circulate, to generate interest, to maintain the illusion of stability. But numbers this large only make sense as long as belief holds. Once belief weakens, scale becomes a liability. There is no central lender waiting to absorb losses. No ultimate backstop with infinite capacity. The system cannot save itself because it is the system. When it fails inward. This is why history doesn't show gradual debt resolution. It shows resets, defaults, inflation, currency redefinitions, structural breaks. The form changes. The function remains. Debt is cleared not through repayment, but through revaluation. Promises are honored in name, not in substance. And afterward, a new system emerges. Smaller, stricter, more constrained, until it grows confident again, and begins the cycle anew. So when people ask who the lender is, they're asking the wrong question. There is no single lender. There never was. There is only a structure that converts belief into obligation and obligation into control. As long as belief persists, the structure survives. When belief fails, the structure dissolves. And the debt that once seemed permanent is revealed for what it always was. A story everyone agreed to tell, until they couldn't anymore.